We now come to the last and the largest section in this reading, which is business combinations. Business combinations involve the combination of two or more organizations into a larger economic entity. Under IFRS, there is no distinction among business combinations. We essentially have one company which is classified as the acquirer and the other company is the target. Under US GAAP, we have four types of business combinations: merger, acquisition, consolidation, and variable interest entity. In a merger, we have two companies, let's say A and B, which merge, and then we have a larger A in the sense that A is simply taking over B and becoming larger. B ceases to exist. With an acquisition, we have company A acquiring company B, and then we still have A and B operating as economic units, but A is considered the acquirer and A will report consolidated financial statements which include the results of company B. In a consolidation, we have company A combining with company B to create a new company called C. And finally, variable interest entity. This is a somewhat different model, and we'll talk about this in detail towards the end of this lecture. How do we account for business combinations? Historically, two methods have been used: the pooling of interest method and the purchase method. The pooling of interest method has been discontinued. US GAAP discontinued it in 2001 and IFRS discontinued in 2004. This method gave way to the purchase method, and in fact when I took the level 2 exam in 2009, we had to study the purchase method. But now both US GAAP and IFRS require the acquisition method. We'll just say a little bit about these two older methods, and then most of our time will be spent on the acquisition method. Under the pooling of interests method, the combined company is portrayed as if it had always existed as one. In other words, the assets and liabilities of the combined company are recorded at book values, and pre-combination retained earnings are included in the balance sheet of the combined companies. Since fair value is generally greater than carrying value or book value, what this approach means is that assets will be shown at a relatively low value compared to, say, the purchase method, which means that depreciation expense will be relatively low. So net income will look good, and most profitability ratios will also look good if the pooling of interest method is used. In fact, in the past, when companies had a choice between pooling of interests versus purchase method, then companies generally, if they could, preferred this method. In the purchase method, however, net assets were recorded at fair value, which is the better thing to do. And as I alluded to, for the same level of revenue, the purchase method would result in lower reported net income because the depreciation expense would be higher. So the profitability ratios would look worse with the purchase method. Now we come to the acquisition method, which is the method that has to be used according to both US GAAP and IFRS. Recognition and measurement of identifiable assets and liabilities. Here there are two major points. The first is that assets and liabilities are brought over at fair value. The second point is that if the investee or the company which is being acquired has developed some intangible assets such as copyrights or patents. And since those intangible assets which are identifiable have been developed internally, it is possible that the book value is zero. When those intangible assets are brought over to the balance sheet of the acquiring company, then even these assets which have a book value of zero need to be brought over at fair value. So if a given copyright has book value of zero, but the fair market value is 5 million, then that intangible asset needs to be brought over at 5 million. Recognition and measurement of contingent liabilities. Here I will read the relevant excerpt from the curriculum. On acquisition date, the acquirer must recognize any contingent liability assumed in acquisition if, number one, it is a present obligation that arises from past events, and number two, it can be measured reliably. There is a subtle difference between IFRS and US GAAP on this front. IFRS includes a contingent liability if the fair value can be reliably measured. US GAAP includes a contingent liability only if the contingent liability is probable and can be reasonably estimated. Next point has to do with the recognition and measurement of indemnification assets. If you don't know the meaning of this term, I suggest you look it up on investopedia.com. Again, I will read from the curriculum. On the acquisition date, the acquirer must recognize an indemnification asset if the seller or the acquiree contractually indemnifies the acquirer for the outcome of a contingency or an uncertainty related to all or part of a specific asset or liability of the acquiree. I don't think this is a hugely important point. Just keep in mind that if the acquiree is effectively giving a benefit to the acquirer and that can be quantified, then that benefit is shown as an asset. Recognition and measurement of financial assets and liabilities. When the acquiring firm acquires the target or the acquiree, and this particular firm has some financial assets or liabilities, then those obviously come to the balance sheet of the acquirer. The target will have categorized these financial assets in a certain way. If you recall from an earlier segment, this categorization could be held to maturity or available for sale. When these assets are brought over, then recategorization needs to take place based on the economic reality at the acquiring firm. When an acquisition takes place, there is goodwill if the price paid is greater than the fair value of the net assets which are brought over. As we will see in an example, there are two ways of measuring goodwill. One is called the partial method, which leads to partial goodwill, and the other is called full goodwill. IFRS allows us to use both methods, the partial goodwill method or the full goodwill method, whereas US GAAP requires the use of full goodwill. And when we do the example on the next slide, we will understand the calculation for both methods. Recognition and measurement when acquisition price is less than fair value. When this happens, then the purchase is considered a bargain purchase or a bargain transaction, and the difference between the acquisition price and the fair value is shown as a gain on the income statement. Now let's take a look at example 7, which demonstrates the calculation of partial goodwill and full goodwill. Note that IFRS allows both methods, whereas US GAAP says that we must use the full goodwill method. We have a very simple scenario. The acquirer acquires another company called the acquiree, and the total value of the acquiree is 1 million. But the acquirer acquires 80%. So 80% of 1 million would be 800,000. The total fair value of the net assets is 900,000, and 80% of 900,000, which represents the share of the acquirer, would be 720,000. Given these numbers, there are two ways of coming up with goodwill. The full goodwill method says that we take the total value of the company, so that is 100% of the company, minus 100% of the net assets. This again is the fair value of net assets. The difference between these two is 100,000. This is the full goodwill. The other approach is to take the 80% share and say that 80% of the company is worth 800,000. 80% of the net assets are worth 720,000. The difference is 80,000. So this would be the partial goodwill. And again, I've said this several times, but I will repeat. This is one of the major differences between IFRS and US GAAP. IFRS says that both methods can be used. US GAAP says that the full goodwill method should be used. Let's work through example 8 now, which demonstrates the impact of acquisition on financial statements. And I want you to read this first so you understand what's going on. To summarize the main points, we have Franklin Company, which is the acquirer. And for simplicity, we are saying that Franklin acquires 100% of the acquiree. Acquiree firm is Jefferson. This acquisition is taking place by issuing 1 million shares. Each share has a €1 par value and a €15 market value. So the total amount that is being paid is 15 million. The first thing that we should do here is figure out goodwill, and that is easy to do. Since we have 100% acquisition, we don't really worry about the difference between partial and full goodwill. The goodwill here simply will be 15 million, which is the amount paid, minus the fair value of net assets. The fair value of net assets is 5.4 million. So the goodwill amount is equal to 9.6 million. If we work in thousands, the way the information here is presented, the goodwill is 9,600. Now let's take a look at the balance sheet of the consolidated company. Remember that assets and liabilities are based on the fair value of the assets and liabilities of the acquired company. What happens to cash? Franklin is 10,000. And then the fair value from Jefferson is 300. So the value of cash will be 10,300. Inventory is going to be 12,000 plus 3,000, which is 15,000. Property, plant and equipment is going to be 27,000 plus 4,500. And then the assets will also include goodwill of 9,600. You can come up with all the numbers and show the consolidated balance sheet. The next slide will give you the exact answer. On the liability side, current payables would be 8,000 plus 600, which would be 8,600. Long-term debt would be 16,000 plus 1,800. Note that we are using the fair value and not the book value. The equity then will be the difference between the assets and liabilities. Here is the consolidated balance sheet. We've talked about these numbers already. The total assets are 66,400. We've talked about liabilities. This is the total liability amount. You subtract liabilities from assets, and you will have total equity of 40,000. The next question is, how do we come up with this categorization of the 40,000? Capital stock is 6,000, additional paid in 20,000, and retained earnings 14,000. The way you come up with this is by looking at this information. Note that the par value is 1. If 1 million shares are issued, then the capital stock will go up by 1 million. Initially our number was 5 million. When capital stock goes up by 1 million, we will have 6 million. Additional paid in capital is the amount that is paid above the par value, and that number is 14 million. Since 15 million is being paid, of which 1 million is going in this category, then the remaining 14 million go in the additional paid in capital category. So we do 6 million plus 14 million, that is 20 million. The retained earnings stay the same, that number is 14 million. So that is where these three numbers come from, and note that they add up to 40 million, which is what you would expect. Let us talk about the consolidation process in a little more detail. As we've already discussed, when we consolidate, we combine the assets, liabilities, revenues and expenses of the subsidiary with the parent. So 100% of the assets and liabilities are brought over at fair value. We need to eliminate any intercompany transactions. For business combinations with less than 100% acquisition, we need to show the non-controlling or the minority interest on the balance sheet. You might recall seeing this at level 1, but I know that most level 1 students don't fully understand this concept of non-controlling or minority interest. You can get past level 1 without a proper understanding of this concept, but you cannot get past level 2 without properly understanding the concept of non-controlling or minority interest. As we have discussed, there is a difference between IFRS and US GAAP in terms of how minority interest is measured. US GAAP says that we should use the full goodwill method, whereas IFRS says that full goodwill method or the partial goodwill method can be used, and clearly the choice impacts the amount that we show for minority interest. Example 9 deals with a situation where we have a 90% acquisition. So this is more interesting than the previous example, and here there will be a difference between full goodwill and partial goodwill, and there will also be a minority interest. I want you to read this and the questions. What I'll now do is give you some hints, and then based on those hints you try and solve this before looking at the solution. The first part actually is quite easy. The property, plant and equipment. Here we simply take the property, plant and equipment that we have for the parent, which is 235,000, and then add the fair value. Note that we are adding fair value, not the book value. And that is what is reported on the consolidated statement. Both IFRS and US GAAP say the same thing. Then parts 2 and 3 become more interesting. With part 2, we calculate the value of goodwill and the value of non-controlling interest using the full goodwill method. And then in question 3, we need to use the partial goodwill method. I'll use the same strategy that I have used earlier. Let us look at things this way: 100% and 90%. What is the full value of the company? The overall fair value of the company is 200,000, and let's just work in thousands. So the overall value of the company is 200. 90% of this number is 180. And this is the amount that is actually paid. What about the fair value of the net assets? That number is right here. It is 160,000. 90% of this number would be 144,000. With the full goodwill method, as we have seen before, we use this 100% column. 200 minus 160 is 40. So this is the full goodwill. Partial goodwill involves taking the 90% numbers. 180 minus 144 is 36. So this is the partial goodwill. What about the non-controlling interest, also called the minority interest? To come up with the minority interest, we look at the difference between the total value, which is 200,000, and the amount which is paid, or 180,000. That is the amount which is actually paid. This difference is 20. Under the full goodwill method, that 20 is shown as the minority interest or the non-controlling interest. It is shown on the equity side and the label is non-controlling interest. What about the partial goodwill scenario? In this scenario, the difference is that our asset value is lower by 4. 36 is 4 less than 40. The reason this number is lower is we are just taking 90% numbers. Since the asset number is lower, on the liability and equity side, we also need a lower number. Liabilities are not impacted, so that 4 must be reflected in the minority interest. The minority interest then becomes 16. What you are noticing here is that with the partial goodwill method, both the assets and the equity numbers are lower relative to the full goodwill method. Now, I have effectively solved this problem for you, but what I want you to do is come up with the consolidated balance sheet using both the full goodwill method and the partial goodwill method. And here is what you should come up with. Notice that cash, inventory, property, plant and equipment, here we simply add up the number from the acquirer and the fair value from the acquiree, and there is no difference between the full goodwill and the partial goodwill methods. The difference shows up on the goodwill front, where, as discussed on the previous slide, the full goodwill is 40,000 and the partial goodwill is 36,000. So the asset amount is lower with the partial goodwill method. Liabilities are the same with both methods, and since liabilities are the same, then equity has to be lower with the partial goodwill method. That equity is lower because the non-controlling interest is lower by 4,000. Some students have trouble understanding the difference between these two numbers, but the concept is fairly intuitive. If you think about the full goodwill method, 40,000 reflects the entire goodwill. It is 100% of the company value minus 100% of the value of net fair assets. Whereas in partial goodwill, we are only taking 90%. When we take full goodwill, 4,000 of this really is the goodwill that belongs to the non-controlling interest. Since this 4,000 is shown as part of goodwill, it is also reflected in the non-controlling interest. On the partial goodwill side, we do not have that 4,000 on the asset side, so it doesn't make sense to have that 4,000 on the equity side either. That is why the number is lower by 4,000 and the non-controlling interest is shown under shareholders' equity as 16,000. On this slide, we take a look at the income statement impact. Notice that on the income statement, the numbers are the same regardless of whether we use the full goodwill method or the partial goodwill method. The sales simply represent the sales of the two entities, and the same holds true with COGS, interest expense, depreciation expense. The depreciation expense is the same for both companies because the value of property, the depreciation expense is the same for both approaches because the property, plant and equipment is the same regardless of the method, and it is also the same regardless of whether we use IFRS or US GAAP. This number, income from continuing operations, represents the total income of the consolidated entity. This also includes the income which belongs to the minority shareholders. If that is a 10% stake, which is consistent with the example we were just discussing, then 10% of the income needs to be subtracted to figure out the income which is available to the parent's shareholders. So the calculation is fairly straightforward. Now, even though the net income is not impacted by the choice of method, but ratios are. If you recall, we said that the asset numbers are higher with full goodwill and the equity numbers are also higher. That would mean that net income over assets will be lower with the full goodwill method, and also the return on equity, which is net income over equity, will be lower when we use the full goodwill method relative to the partial goodwill method. Goodwill impairment. Goodwill is not amortized, but it must be tested for impairment at least annually. I'm sure you've heard this several times. Once goodwill is written down, it cannot be restored. There is a difference in the way IFRS and US GAAP treat goodwill. Under IFRS, goodwill is allocated to the acquirer's cash generating units, and goodwill impairment testing is done using a one-step process. Goodwill is impaired if the carrying value is greater than the recoverable amount, and if that is indeed the case, then we find the difference of these two numbers and write down goodwill. The loss is then shown on the income statement. Under US GAAP, goodwill is allocated to the acquirer's reporting units. Goodwill impairment testing is done using a two-step approach. First, we identify the impairment possibility by comparing carrying value and fair value, and then we determine the implied fair value of goodwill, which is equal to the fair value of the overall reporting unit minus the fair value of the net assets. This difference is shown as a loss on the income statement. Let us work through examples 10 and 11, which demonstrate goodwill impairment using both IFRS and US GAAP. Here is what we do with example 10, which is based on IFRS. The recoverable amount is 1.3 million. The carrying amount is higher, 1.4 million. When we look at the difference of these two numbers, that is 100,000. This is how much we need to impair goodwill by. Goodwill, which was initially 300,000, needs to be impaired by 100,000 and comes down then to 200,000. While not explicitly asked over here, but the solution in the curriculum also points out that if the recoverable amount had been 800,000, then we would first get rid of all this goodwill. So write goodwill down to 0 and recognize that as a loss. And in addition, we would have a further loss of 300,000. So the total impairment would be 600,000. That 600,000 would reduce goodwill, and then the rest would be allocated to the cash generating units. So the cash generating units would also be written down. Example 11 talks about goodwill impairment in the US GAAP context, and here we have a two-step process. First, we compare the fair value with the carrying value. If fair value is less than carrying value, then we impair. Then in step 2, we compute the impairment loss, and we do that by coming up with the implied goodwill. The implied goodwill is equal to the fair value of the reporting unit minus the fair value of the net assets. And the fair value of the net assets is 1.2 million. Take the difference and we have an implied goodwill of 100,000. But the goodwill that is shown on the books is 300,000. So that 300,000 needs to be written down to 100,000. This is the new goodwill amount, and 200,000 is shown as an impairment loss. Section 6.5 deals with financial statement presentation subsequent to the business combination. And here we are looking at an excerpt from the financial statements of GlaxoSmithKline. As a general point, if you want to understand mergers and acquisitions and reporting of consolidated financial statements, then study the pharmaceutical industry, because there is lots of consolidation activity and investment activity in the pharma sector. There is not too much to talk about over here, but notice that we have a substantial amount of goodwill, which means that several acquisitions have been made. Also, connecting with an earlier section, we see investments in associates and joint ventures. So here the equity method has been used, one-line consolidation. The details are shown in footnote 20. On the equity side, we see this non-controlling interest. So that also confirms the fact that we have acquisitions. Here is another general point that I'll just read out. IFRS and US GAAP have similar formats for consolidated income statements. Each line item includes 100% of the parent and subsidiary transaction after eliminating any upstream or downstream intercompany transactions. The portion of the income accruing to non-controlling shareholders is presented as a separate line item on the consolidated income statement, and that is shown right here. This is the total profit. This is the profit attributed to the non-controlling interests or the minority interests, and this is the amount attributable to the shareholders of the acquiring company. Variable interest and special purpose entities. This term, special purpose entities, is used in both IFRS and US GAAP. The term variable interest entity is used in US GAAP. Special purpose entities are created to accommodate specific needs of the sponsoring entity. The sponsoring entity frequently transfers assets to the SPE, obtains the rights to use assets held by the SPE, or performs services for the SPE, while other parties provide funding to the SPE. SPEs can be a legitimate financing mechanism for a company to segregate certain activities and thereby reduce risk. SPEs can take the form of a limited liability company, a trust, partnership, or unincorporated entity. Here is a simple example of the creation of an SPE. Let's say we have a company which is called the sponsor company. The SPE E is created by the sponsor. And let's say that the sponsor needs to buy a very expensive asset. What can happen here is that the SPE buys the asset and funds the purchase by borrowing from the debt market. Since the asset is owned by the SPE, this asset can be used as collateral, and since the collateral is very well defined, the cost of borrowing here will be relatively low. If the sponsor were to directly buy the asset and use borrowed money, the cost of borrowing might be higher if the sponsor doesn't have a good credit rating. So one of the major advantages of using this mechanism is that it can potentially lower the cost of financing. But once this is done, then the asset is really there for the sponsor to use, and the sponsor makes lease payments to the SPE, and the SPE lets the sponsor use the asset. So effectively, this is a leasing arrangement between the sponsor and the SPE. Now you can hopefully understand how this mechanism can be exploited. In the past, before there were rules about the SPE being consolidated, what the sponsor could do was create this SPE and effectively have the assets and the liabilities off balance sheet. So the assets and liabilities would be sitting over here. The sponsor would show a nice revenue and a nice net income, but the asset values and the liability values would be very low. So return on assets, return on equity numbers would generally seem very good, and the leverage ratios would also seem quite good. But both US GAAP and IFRS now have very strict rules which ensure that SPEs are consolidated. And once the SPEs are consolidated onto the financial statements of the sponsor, then the assets and the liabilities come over. I alluded to this term, variable interest entity. A variable interest entity is a US GAAP concept and refers to an entity that is financially controlled by one or more parties that do not hold a majority voting interest. So the SPE in my previous example would fall in this category. So an SPE could be a variable interest entity. Notice in the previous example, if most of the funding is coming from external sources, the sponsor doesn't have a majority interest in the SPE, but the sponsor does control and benefit from the SPE. Specifically, a SPE is a variable interest entity if the following hold true. The total equity at risk is insufficient to finance activities without financial support from other parties, and the equity investors lack any one of the following: the ability to make decisions, the obligation to absorb losses, and the right to receive returns. So if we have this SPE created and they are external shareholders, but they cannot make decisions or they do not have the right to receive returns, or if they are protected from losses because the sponsor is taking care of the losses, absorbing the losses, then the SPE is classified as a variable interest entity, and the primary beneficiary of the variable interest entity, which would be the sponsor, would then have to consolidate the SPE as a subsidiary regardless of how much the equity investment might be. Just to connect this with material that we have studied earlier. Earlier we have said that generally if the equity stake is 51% or greater, then we consolidate. Between 20 and 50% we use the equity method. But here, if an entity is defined as a variable interest entity and the equity stake is only, say, 6%, we still need to consolidate. Now let's take a look at example 12 from the curriculum, and I want you to read this and do this first before looking at the solution. Here is what you should come up with. This is alternative 1, where the borrowing is happening against the receivables. So notice that the receivables number stays the same. The non-current liabilities go up from 20,000 to 75,000. That is because the borrowed amount is 55,000 as indicated in the question. Now what about alternative 2, where a special purpose entity is created? Up here we see the balance sheet for the SPE. The accounts receivable of 60,000 are sold to the SPE. So the SPE shows 60,000 as accounts receivable, and that is the only asset that the SPE has. The long-term debt is 55 million. This debt has been raised with the receivables as collateral, and the equity investment is 5 million. Clearly in this example, the sponsor, which is Odena, is the beneficiary. And since the sponsor is the beneficiary, this SPE needs to be consolidated into the sponsor's balance sheet. Notice that this consolidated balance sheet looks exactly like what we have in alternative 1. I also want to point out that in the past, where this consolidation was not required, companies could really exploit SPEs by creating the SPE and showing their balance sheet without the receivables and without the loan. So companies would look a whole lot better than they actually were. And in fact, companies like Enron did do this quite a lot. Section 6.7 describes additional issues in business combinations that impair comparability. There isn't much detail in this section, and I don't think it is very testable. What the curriculum talks about is subtle differences between IFRS and US GAAP in these categories, and the basic idea is that there is a fair amount of subjectivity involved in these items, such as contingent assets and liabilities, contingent considerations, how to record in-process R&D. And as analysts, we need to recognize the fact that there is subjectivity, and we need to be careful when we compare different companies. If you want more details, you can read the curriculum, but again, I think the probability of being tested on the specifics here is relatively low.